What if I told you the situation with commercial real estate has gone from bad to worse? That's what we'll cover first. The next thing I want to look at is the only chart you need to see to be able to invest appropriately. The only chart. I'm talking about something that is straight to the point, and yet the vast majority won't cover it because it's too easy. If you follow this, you don't need to follow them. Well, I'm going to give that to you, okay? And then we're going to look at all the data, all the charts, so much to cover. My name is David Quintieri, and that's what I do. I give you a whole bunch of information squeezed down from hours and hours of research. All you got to do is subscribe, and you get the latest and greatest. Let's begin by taking a look at this. You can see what's happening inside of commercial real estate, particularly with offices. This is showing us the occupancy data, and that it's varying greatly by city, but there is two trends. We are way off where we were at the beginning of 2020, still today in all of these major cities. The second thing is that each of these cities is getting better. We are getting closer and closer. But look, for a lot of them, we can average that out at 50%. This covers all different cities, whether that's Houston and Washington or New York. San Jose is in the worst position, I would say. If you look at that chart, the dark blue line, bottom right corner area, that's San Jose. So you have a lot of these different, tech companies. A lot of them, the workers, are saying we are not going to work from work. We're going to work at home, and that's the end of that. I think a lot of people personally had moved out into more affordable places. So maybe they're working in San Jose, maybe they're working in New York, they're working in all these major cities. The price of the homes are extreme at that point. But they said, hey, I can go out into the middle of nowhere, or maybe just, a tertiary city or something. I'll stay there and I can get a home for much cheaper. But then their bosses said, well, now you got to come back into the office. And they're saying, no, I don't want that. I don't want that. And it's probably I can't even afford that at this point. And so this is the issue experienced all along. Now, that's one side of it. But what about the debt? You see, all of these properties, they're all carrying debt. And somebody's got to pay that. But if you don't have the tenants in these places because Microsoft and whoever other tech companies are not actually using the space they did before, well, as they consolidate, you now have a landlord that doesn't have enough space, enough income coming in to fill all that space. This is an issue. So you got the commercial mortgage-backed securities that are front and center on my radar. That's what I'm looking at. Okay, and if you want to just keep up to date with that, you just stay tuned to the channel. I'll bring you all the details. This is the biggest concern, and it is also a concern for a lot of the prominent investors out there that I've been paying attention to. Okay, so keep your eyes peeled on this. Let's cover the next aspect. You can see it. Office loans fall behind on their payments at a higher rate. So I'm not just making this information up. You can see this right here. The delinquency rate, specifically for offices, has been ticking up basically since the beginning of 2023. Now, we don't have to see, I think people get this a little bit carried away here. You don't have to see it at, 50%, 80% for it to be a problem. It doesn't really work that way. Another concern, of course, is that we also have retail. Retail is a big problem because they quite frankly don't need it all. I see this going a few ways. Okay, so I've spoken with a lot of people about this, and I want to share my thoughts about it. Retail. For so many people, they are willing to buy basically anything online, and that's just the way it goes. The other model is what we're seeing with Walgreens, Walmart, like all these different companies that are basically locking everything up, and you go to the teller at the front and you say, I want that product, that product, that product. They bring it to the front. At the same time, what did 2020 do? Lockdowns, curbside pickup. Curbside pickup, you order online, but you physically go to the store to pick it up, okay? You park in space number 3, you click that on your phone, the guy comes to you, puts it in your trunk. It's a service, really, okay? So what's happening here is that you no longer need retail, or you don't need retail in the way that we were used to. You're just going to go around the store for 2 hours while you end up buying all these unnecessary products. That's certainly one advantage of online shopping, is that as you're going through, you're getting only the things you need, and then the advertisers can't bombard you with what they want, and things that are on the end cap of the aisles showing, oh, this is a discounted price. Oh, I don't really need it, but sure, I'll take that anyway. That's what a lot of that is done intentionally inside of a retail establishment. So for good or for bad, that's certainly what's happening. So that's the issue I see with retail. I also believe that what's changing here is not going to be for the luxury market. I think if you're buying a $10,000 suit or a $5,000 suit, you're going to get tailored. You're going to go in there. The guy's going to give you an espresso. You're going to have that. Maybe you're going to go to one of the luxury brands. You're going to go get a Burberry trench coat. You're going to get the story of Burberry. You're going to get all that experience. And there's only 3 people in that store. It's not like going to Costco and people are ramming your cart. And I've been there, and it looks like somebody's trying to attack you. Anyway, the point is, it's a very different experience. For the luxury market, that there's still going to be a retail establishment, that you're going to be going in there and you're going to get a different level of experience. So retail, office, these things are changing right now, but when you segment that down, you got to realize that there's a difference here. And I want to make that clear. Why would I tell you that? Number one, for your own purposes, this is the way it's going, okay? I've channeled this information and you're getting it here first. But the second thing is that I think as investors, you should be aware of which market the companies that you have invested in, either directly as a stock, less directly by having an ETF, or you have a retirement account, okay? So you got to be aware of all this stuff, the changes and the trends that are coming, regardless of whether we're going to lockdowns or not. I mean, that just accelerated. 2020 just accelerated the trends. At the same time, we have large CMBS, that's commercial mortgage-backed security, loan maturities that are hitting in 2023 and 2024. A lot of that coming this year and next year. And of course, they're going to be mature. And then what happens? Are they going to be able to renegotiate that at a rate of, whatever they're paying at this time? Is that going to be 6%, 7%, 10%, whatever the case may be? It's a little different, of course, with commercial real estate, and depending what type of real estate in commercial, because commercial could mean multifamily properties, or that could be industrial. It could be, all these different things. So we're not talking about residential on like a single family home. Work from home and the office real estate apocalypse. So this is a study here, and I thought it was really interesting. So we show that remote work led to large drops in lease revenues, occupancy, lease renewal rates, and market rents in the commercial office sector. We revalue New York City office buildings, taking into account both the cash flow and the discount rate implications of these shocks, and find a 44% decline in the long run. Did you hear what I said? Think about that for a moment. The implications of these shocks, and find a 44% decline in the long run value. For the US, we find a $500 billion value destruction. High quality buildings were buffered against these trends due to a flight to quality, while lower quality office is at risk of becoming a stranded asset. These valuation changes have repercussions for local public finances and financial stability. This is huge. Now, of course, speculation, right? But isn't it correct in the way that we make these assumptions about what's happening with retail, what's happening with the office? Very big changes. At the same time, something that I would like to note is that people have moved out of the offices, but into their homes. So in this case, residential real estate looks strong because the people they're saying, no, I'm not going back to the office. That's not happening. And a lot of businesses are saying hybrid model, work from home, work from the office half the time. So you're going to see that trend, I think, just, oftentimes you'll see that continue on. It depends on the city, depends on the type of industry as well. Some things you just can't work from home. Okay, if the city is relying on oil and gas and there's a lot of mining that takes place, people have to be there. That's just the way it goes. Okay, here we have it. Constrained home purchase activity, mortgage applications register their fourth consecutive weekly drop. So this is something else I wanted to note, and that's just basically people waiting on what's happening with mortgage rates. They're over 7% in the United States, and you look around the world, a lot of countries, whether that is Canada or others, that are just, they're just saddled with debt, and they want to wait it out. They want to hope that interest rates will go down. Now, this is the big one. You waited until this point of the video. I want to thank you for being here. There is only one chart that you need to follow, and I would say one thing you need to follow, and that is the money mirror method. This is what I talk about here on this channel. I have coined the term. I didn't, decide that this was the way it goes. I just coined the term. And money mirror method basically suggests that wherever you look at the amount of money being pumped into the system, you will see on the other half the stock market going in line with it. If they're pumping more money into the system, more cash on hand, more liquidity, you will see the stock market rising, and vice versa. If they pull money out of the system, you will see the stock market declining. And that, there's a lot to that. It's not just one very, very simple metric that you're going to pay attention to, but that's the generalized way to look at it. Money moves into the system, stocks go up. I talked about this back in 2019. If you simply follow that along through 2020, you would have made money the entire time. Simple matter of fact. Okay, I have videos about that. You can search The Money GPS 60 seconds. That's all you need. The Money GPS 60 seconds, and you find that video. Let me ask you, are you finding this valuable so far? If you are, hit that like button down below, and I'll show you the next part of this. Take a look. Here we have it. You can see the comparison of the US reserve balances with Federal Reserve banks. That's an important metric. How much cash is on hand? That's what they're talking about here. All right? So it's like the Federal Reserve balances. How much liquidity is there at these banks? Commercial banks are able to basically park their cash at the Fed. Now that can change in an instant. However, it happens to be directly correlated. Look at this over the past few years. This chart goes back into 2021. And you can see the total market cap for the United States and the comparison there. Isn't it directly correlated? The amount of liquidity, the amount of cash sitting there, compare that with the stock market. Isn't it so wonderful to see a chart match up this accurate? Yeah, there are going to be times it's up, it's down, whatever, but that is pretty accurate to say the least. You want to know more about this? Stay tuned to the channel and I will bring you constant updates. Just hit subscribe, okay? I'll bring that to you. No catch. You don't have to pay anything. Just subscribe to the channel. Now here's some information that I thought you'd be interested in, looking at what the Federal Reserve is doing. Time and time again, you see it. Federal Reserve balance. This is the basically showing us how much money, what it is how much money the banks are borrowing from this facility that the Federal Reserve has set up, okay? So it's supposed to be temporary, it's supposed to be all this, and, banks are using this, even though there are many other ways that they can get liquidity. This is at an interest rate that's not really that reasonable, and they're borrowing more, they're borrowing more, they're borrowing more. We're having a liquidity problem inside of the banks themselves. Part of that is with commercial real estate, and part of that is happening with the bank crisis that's going on. You could see money market funds continuing to see a lot of cash flowing in. I guess as people are getting their paychecks, they don't really know what to do. They're pumping that into the markets for sure, but not as much, I believe. And there's, money markets are kind of a way to say, I'm going to put my money here and just kind of wait and see. You could see what has happened. The Federal Reserve balance sheet itself increased slightly. This is going to obviously be up and down depending on the day, the conditions, and so on. But it has increased slightly. But if we look at the treasuries, the mortgage-backed securities, that has continued to decline. So I'm just giving you the full spectrum picture as to what is happening here with liquidity and the money supply as a whole. Treasury Secretary Janet Yellen, my favorite, says that she wouldn't be surprised to see more bank consolidation. And so this is really supposed to signal what we could see in the next little while. The bank crisis is not over, that's for sure. And this is just one aspect of that. I think it's really important to follow along with what's happening with this liquidity, with what happens in the banks, and of course, commercial mortgage-backed securities, or let's just say commercial real estate in general. It's going to be something that you cannot get away from. Now, this right here is just one part that I think you should get into next. It is planning for your retirement. I know a lot of people are concerned. They are worried what's going to happen to my retirement account. In this video, I talk about that right here. Click it and I'll see you there.